So we had this angel investor who was the perfect person. They were a local investor here in San Diego. They'd been investing in a bunch of cool companies. And we thought we were a shoo-in, that we had just prepped so much for this one particular pitch. And it was like an instant no. It was like, two-sided marketplaces will never work. I don't invest in them. You guys will not be successful. And it crushed us because we thought it was going to be a slam dunk. And you know, it sucked. You feel like in that moment and like the 30 minutes or hour after it, that like everything you've been working for is just like a waste. It's been a waste of time. Just because they didn't invest, I have no problem with that. Like, let's just bounce back. Let's go back to the drawing boards. Let's pitch someone else the exact same pitch that we just prepared so much for and see what their perception is of it. And of course, the next person we pitched, also a savvy angel investor in town, was like, this is brilliant. Like, it was just the time to digest the no and bounce back, knowing that we're the ones invested the time into the research, into the problem, solution, market opportunity, the vision for the company. Sometimes you just got to have the right person believe in you. Just because an investor has money doesn't mean it's always the right fit. You have to build out this like prospective investor wish list. You got to have like your tier one investors that might be a little bit harder to get to, but they're the ones that might write the biggest checks. And then you have your tier two investors that are still accredited investors. Maybe they make some tech investments. Maybe they're a little more traditional with their investments, but you have to have this pipeline just lined up as much as possible with introductions, warm introductions, or if you know the people, until you get that funding. Because until the money's in the bank, the deal is not done. And I think that that's one of the hardest things as a founder to deal with, is that rejection, like constant rejection. And if you don't have this pipeline of investors, you're literally just chasing cold leads and end up wasting your time when you could be building the business. As soon as you start to have, like, you raise bigger rounds of capital, you start to care less about the no's from those early days, because you're like, hey, they're lost. Like we took our angel investors investment and we've 10x'd the ROI based on the company's valuation already. Like, how do you not want in on something like that? So it kind of feels good after you raise money like that. Not that it's about how much money you raise with valuation, but for a personal founder, like it feels good to kind of like rub it in the face when they're like, hey, like, can I get in still? And you're like, nope, you should have gotten in when I asked you the first time. Because it's not like anything changed. Like nothing changed. The strategy was the same. The team was the same. The product was the same. And like my favorite example of any company that dealt with a lot of no's is Airbnb. Brian Chesky has this Medium post that he's infamous for, where he got rejected 7 times. His first 7 pitches for Airbnb was $150,000 for 10% of the company. Airbnb is worth $30 billion today. And I know for a fact those 7 investors are kicking themselves in the ass right now. Putting myself in investors' shoes, I think what I learned that I didn't understand at the time is like, if you're investing in the earliest of stages, it's the riskiest investment. You basically have to assume that you're going to lose this money. It's like 95% of startups fail, I think is the statistic. But the thing that's interesting is, like, for an investor, all they have to do is find that one thing they don't like about the founder, the company, the business model, the strategy, and that's their out, because it's so easy for them to say no. The yeses are so damn hard to get to. That was something that always surprised me, is like, we, in the earlier days of industry, but once we had raised money and were having success, I was kind of surprised sometimes that like we would reach out for partnerships, and it was typically like, you know, a little bit slower run organizations where they just wouldn't come around as quickly to wanting to work together. And I was like, okay, like I'll leave you in the dust. And then like, so and behold, 6 months later, a year later, they come back and they're like, hey, like we should totally partner up. And I'm like, no, you need us more than we need you now. So good luck. I don't know if I'd want to do it differently, because maybe I wouldn't be here at this point in my life if I would have done it differently. But I do kind of wish that I went and worked at like a Series A funded startup. So like just past the point where like when it's a angel to seed funded company, it's like really risky. There's like a lot of, every day is a new challenge. But a Series A funded company, it's typically growth capital, and usually they have most of their shit together. And I kind of wish that I would have gone to work at a Series A startup, because it's early stage enough where you can still learn and grow tremendously, but it's structured enough where there's a little bit of job security, and working at a company like that for a year or two gives you this foundation that you can apply to so many different companies, from starting your own company to going and working at another startup, or even bringing that startup mindset to a bigger company and organization. I think that it's like those individuals in my network that worked as an employee at a Series A funded company are typically the ones that are doing the most in terms of financial success to some extent, 4 or 5 years later, post college. I've been saying it for 6, 7 years now, is get comfortable being uncomfortable. One of the things that I liked, and I don't know why I naturally gravitated towards this, but with startups, is these pitch competitions. Sometimes they can be a distraction, especially if you only think that pitch competitions validate your business. If it doesn't drive new customers or user growth, it's a waste of time. But in the early days, it is kind of validating to get up in front of a room full of strangers, whether it's 10 people or 100 people. Like we just did it in front of 600 people with my new company. And to convince them everything about your business in a few minutes flat, like usually pitches are 2 to 5 minutes for pitch competitions, and to get them to care enough to take action, whether that's to sign up for your beta, to sign up as a customer, or even to tell a friend that would benefit from your product or service. And I think that it's something that not enough founders think about practicing or get good at. And if you can't convince a room full of strangers to care, how are you going to convince an investor to write a check? It takes time, like I said, but like you get to this point mentally where you know your business better than anyone else. You start to know the industry pretty darn well, better than most people at a very macro level. And being scrappy, like literally understanding like you built this business when there wasn't money involved, when there wasn't a big team, when you didn't have a big marketing budget. It's like those scrappy strategies that I think sometimes, like, if you've made it to a point where you're actually starting to feel successful and the company is successful, you're like, damn, if we can get here being scrappy, imagine what we could do if we're making a bunch of money and how we can reinvest it into the company and continue to scale it and be more successful.